On December 3rd, your company provides services to a partner corporation. This is your revenue. As per agreement, $6,800 will be collected by you next month related to this service. All right. So this problem right here probably could be written a little bit clearer to understand it, but we can kind of get the gist of it. This amount right here, this 6,800, this is the amount that we actually are going to have related to the services. All right. So let's do the journal entries for December 3rd. And then let's do the journal entry for January. And let's assume they just pay on the 3rd too later, okay? So your company provided services to a partner corporation. This is your revenue. Oh my gosh, it gives you one of the entries right there. As per the agreement, $6,800 will be collected by you next month related to the service. That means it was sold on account, all right? So let's start with our debit and our credit here. Debit and credit associated with this sale, all right? So we're debit. So do we get cash? No, we got an IOU. We call those accounts receivable. Accounts receivable. I'm going to put receivable right here. Accounts receivable. And we're going to say it's 6,800 related to this right here, all right? And how do we record this account receivable here? How does that actually end up being tracked? Is that an expense, loss, liability, owner's equity? Well, it is revenue because it says right here. So we could call it sales revenue. I'll just put revenue right here and revenue of $6,800 right here. All right. So that is the journal entry for December 3rd. That's what we have. All right. Accounts receivable and revenue. All right. So January 3rd, this next month, all right, the month later. All right. So technically, this is all that would be required because the tone of this sounds like next month related to this service. It means that you're recording just this transaction right now. But let's see what the journal entry would be next month. All right. So next month, you would have a debit and you would get cash because it's getting paid to you, right? Cash is getting paid to you. And that account to correspond to this accounts receivable, and the account receivable that you have will be written off. So the 6,800 is written off. It's going out. It's showing that, hey, somebody paid us this 6,800 in cash that was on account, and it is now paid in full. All right. So where does this come in? So the original sale, the December 3rd transaction, December 3rd, is accounts receivable here at 6.8K right here. All right. So 6,800. All right. I'll just put that there. And then revenue on the income statement, revenue of 6,800 right here. All right. And that's our December 3rd. In our January recording, we have cash that we receive, and this account receivable is going to be moved over as a credit. So the account receivable is 6,800, and what that lets us know is that this is out of here. When assets go down, whatever is being written off, the account receivable is gone. That means it's going outside the organization. That means we can't go back to the person that just paid us cash and say, hey, you still owe us account. And if we left it as a debit, we would. If it was left as a debit, we'd say, oh, we still have all these accounts we can collect. When the reality is we already got this cash of 6,800 from this customer. And so this is how you do this journal entry.